Hi, here we are. We are ready for class 24A on the Monday, Wednesday, Friday schedule. So this is your class 24. You're going to have two separate videos, two kind of shorter rather than one really long one. And then if you're on Tuesday, Thursday schedule, this is for class 17. This is the first half of your class, so 24A or 17A, depending on what you're up to. So we're moving along down the balance sheet. So last chapter we talked about cash. This chapter we're going to talk about accounts receivable. So really not a brand new concept. We've always had accounts receivable, but now we're going to drill down a little bit and talk about, well, how do we calculate those? What do we really mean by that? And get a little detail like specific situations. Right? So let's talk a little bit more about accounts receivable so we understand them a little better. All right. So let's talk about what are the common types of receivables and what do we do when we get a credit card sale, because they don't really pay us cash. So what's that? All right. A receivable occurs when a business sells goods or services to another party on account. So you should be pretty familiar with that by now, on account, or on credit as we call it. It is a monetary claim against a business or an individual. The receivable is the seller's claim for the amount of the transaction. Receivables also occur when a business loans money to another party. A receivable is the right to receive cash in the future from a current transaction. It is something the business owns. It is an asset. Each receivable involves two parties, creditor and the debtor. The creditor receives a receivable, the asset. The creditor will collect cash from the customer or borrower. The debtor is the party to a credit transaction who takes on an obligation or payable, a liability. The debtor will pay cash later. The three major types of receivables are accounts receivable, notes receivable, and other receivables. So it's important to keep it straight. So we're talking about receivables right now. So if you're doing the accounting for a company, right? So we're doing the accounting for learning systems, and a receivable means a customer came in and got some of our services and is going to pay us later. All right, so that's an asset to us. We're doing the receiving. Now that other person does owe us. So for their part, it's a payable. We're not talking about payables. We're talking about our receivable that they owe to us. We are going to receive cash from them in the future because we did some service now. All right. Accounts receivables are sometimes referred to as trade receivables. An accounts receivable is the right to receive cash in the future from customers for goods sold or for services performed. Accounts receivable are treated as current assets and are usually collected within 30 to 60 days of the billing date. So this is what we've been writing, A/R, accounts receivable. So we made a sale, right? So we recognize that sales revenue as the credit and we wrote account receivable as the debit. That's what we're talking about. Trade receivables are sometimes what they get called by some other people. We're going to call them accounts receivable. It means you sold something, people didn't pay you cash, they're going to pay you like within 30 to 60 days. What's another kind of receivable? Well, there's a note receivable. Notes receivable arise when a company loans money to its customers or another individual or business. Notes receivable usually have longer terms than accounts receivable. A note receivable is a written promise that a customer will pay a fixed amount of principal plus interest by a certain date in the future. The maturity date is when a note is due. So a note, just that word note, like you wrote a note to somebody. I sent them a note. Well, a note's an actual piece of paper. So a trade receivable, account receivable, like on the last slide, just like, hey, we're making a sale, it's something we do all the time, and you've established a credit with us, so we're just gonna go ahead with that. Whereas a note receivable, sort of like more formal, like, well, you've owed us this amount for a long time, now we're gonna have to charge you interest and make you sign an actual piece of paper. It's gonna be more formal. Or, maybe an employee needs to borrow money. I'm having an emergency. Well, you're such a good employee, we're going to lend you some money, the company. Right? So you have them sign a note that they're going to pay it back. So a note's just more formal. Notes receivable are generally evidenced by a legally binding document called a promissory note, a written promise to pay a specified amount in the future. Usually, the signer agrees to pay interest at a specified rate. Notes receivable are generally long-term assets, but some notes receivable may be short-term assets for 90 or even 180 days. So what makes short versus long-term, in other words, current versus long-term asset, is how quickly it's going to be converted to cash, right? So a current asset converts to cash within a year. And anything longer is longer. So usually, a lot of times notes are longer, but not necessarily. No, it could be a current asset. It just depends on when that thing matures, right? So is it a year or is it less than a year? Other receivables. So you may have something that's not an account receivable or a note receivable. Other receivables make up a miscellaneous category that includes any other type of receivable where there is a right to receive cash in the future. Common examples include dividends receivable, interest receivable, and taxes receivable. These other receivables may be either current or long-term assets, depending on whether they will be received within 1 year or less. So anything that doesn't fall in this category of we made a sale, so we got an account receivable, or here's a formal promissory note, just some kind of random receivable. Somebody owes some interest that you're going to collect. Maybe the bank owes you interest. It's the end of the year. You've got a CD. They're going to pay you some interest. You want to recognize it on the books, but you're not really going to get it for a while. That might be interest receivable, something like that. Just random things. All right, so that's what we mean when we're talking about receivables. So that's when we talk all this chapter, we're going to talk about receivables. That's what we mean. All right, so how about talking about accounts receivable and how we record them? You should be pretty good at this. We've been doing this for a few weeks now. As stated earlier, selling on account on credit creates an account receivable. Businesses must maintain a separate accounts receivable account for each customer in order to account for payments received from the customer and amounts still owed. So up till now we've just been writing accounts receivable, right? But when you really think about it, wouldn't you have to keep them all separate? You know, because you have to keep a track of who's paid you how much, right? So you keep them separate. For example, Smart Touch Learning performs $5,000 in services for Brown on account and sells $10,000 sales price of merchandise inventory to Smith on account. On August 8th, the inventory, the revenue is recorded. So here's two different sales. All right, one is to Brown and one is to Smith. So you can see we're at accounts receivable dash Brown, accounts receivable dash Smith, right? The revenue, right? So those are what we mean by keeping the accounts separate. So from now on, when you write down an accounts receivable, don't just write account receivable, write account receivable Smith, account receivable Brown, account receivable Scalon. Whoever owes you that money, you write that down so you make sure you're getting the right amount from the right people. Now, these separate customer accounts receivable, for example, accounts receivable Brown, are called subsidiary accounts. SUBSIDIARY accounts, subsidiary accounts. The sum of all balances in subsidiary accounts receivable equals a control account balance. So here's that word control. Remember how we talked about internal controls are what makes sure we meet our objectives, and it's how we make sure we're keeping good financial reporting. Well, here's an example of a control that's helping us make sure we're recording our accounts receivable correctly. So obviously you want to keep a separate one for Brown and a separate one for Smith. And you want to keep an accounts receivable control account that keeps the totals of all of them. So this, right, Brown 5,000, Smith 10,000 equals 15,000. So you're keeping another account going that just keeps a running total of all your accounts receivable. And this accounts receivable, the control account, is what goes on the balance sheet, right? So when you think about it, it'd be pretty complex and hard to read balance sheet if you put every single account receivable you had on there. So obviously, to get people to pay you the right amounts, you keep track of them separately. But to go on the balance sheet, you also keep track of them as a total, right? So think about, you may have some kind of a credit card that has an account, or even a debit card has an account number. That's your bank keeping track of you separately. But they keep track of all the checking accounts or all the credit card accounts and report them on their financial statement as one big lump. Checking account balances, credit card balances, right? So control accounts are just the total of the subsidiary accounts. It is obviously impractical to include each individual account receivable on the balance sheet. A control account, accounts receivable, is maintained to represent the total of all the individual subsidiary accounts. All right, so recording sales on credit. When the business collects cash from both customers on August 29, 4,000 from Brown and 8,000 from Smith, Smart Touch Learning records the payments in a journal and posts the entries to the TuTh account. So here's the journalizing. Cash came in 12,000. Accounts receivable Brown, accounts receivable Smith, right? Your debit for the cash increasing, and these two assets decrease, so they get the credits. All right, so there you go. So that's how you post that payment using subsidiary accounts. And you don't have to worry about posting to the control account because your computer is going to automatically do that. You don't really have to post them separately. All right, now what happens if there's credit or debit cards? Because it seems like, well, that's not really cash, but there's not a separate account receivable, all right? So in addition to selling on account, most companies also accept credit cards and debit cards. By accepting credit cards and debit cards like Visa, MasterCard, American Express, businesses are able to attract more customers. Businesses benefit from accepting payment by credit and debit cards because they do not have to check each customer's credit rating or keep account receivable records. There are two methods allowable for recording credit card and debit card sales: the net method and the gross method. Net, N-E-T, and gross, G-R-O-S-S. Under the net method, the total sales less the processing fee equals the net amount of cash deposited by the processor, usually within a few days of the sale. Under the gross method, the total sale is deposited within a few days of the actual sale date. The processing fees for all transactions processed for the month are deducted by the company's bank account by the processor, often on the last day of the month. So what's happening in a credit card sale, the store, like you go and you swipe your card. You don't think anything about it, right? You've paid for it with your card. What's happening in the background is that store's bank is processing that for them, right? And and that money will just automatically get put in that store's checking account. Now, there's two ways to do this and account for it, net or gross. So there's some little fee, like charged 1%, 2%, just depends. So when you use that, when that card gets used, there's a processing fee. So if you net it out, remember that word net means you've subtracted everything out. Remember, we've had net sales, which means sales revenue less returns allowance less discounts, and then we get net sales revenue, or net income, right? Revenue minus all the expenses equals the net. So that word net means you've subtracted stuff out. So for credit cards, when we talk about net method, it means we've subtracted out that little fee, and we don't even post all the cash. We just post the cash net of the fee. For the gross method, as sales are occurring, we're posting all of it as cash. All of it as cash. And at the end of the month, the bank is going to charge us one big fee instead of a little fee each time it happens. So net fee, the seller's getting charged a little bit each and every sale, whereas gross method, at the end of the month, one big chunk of processing fee. All right, so let's look at this. Recording credit card and debit card sales. Under the net method, the seller records the total amount of the sale at the time of the sale. The anticipated amount of the fee is deducted, and only the net amount of cash is recorded. So here's an example. On August 15th, Smart Touch Learning sells merchandise to a customer for $3,000. The customer pays with a credit card. The credit card company assesses a 4% fee. The full $3,000 is credited to sales revenue. 4% of the sale, or $120, is charged to credit card expense, and the net amount of cash is debited to the cash account. All right, so here you go. So if you're keeping the books for Smart Touch Learning, a customer made a purchase. So it's on a credit card though. Well, I know cash didn't really transpire, but we're going to count the credit card same thing as a cash. All right, but under net method, we net out that fee, which is 4% or $120. So you get your cash to $28.80, your fee, which we call credit card expense, $120, but the sales revenue is $3,000. So your debits equal your credits, and you're all good. So net method takes that little bit of fee up front. So let's suppose we're doing the gross method, which means at the end of the month, we're going to take it all out. Under the gross method, the full amount of the sale is credited to sale along with the full amount of cash. The fee is recorded later when the credit card company actually deducts the amount from the cash it pays the seller. So here you go, August 15th, same exact sale, $3,000. So you just call it cash, $3,000, sales revenue, $3,000. The customer pays the fee. This will require 2 journal entries on different dates. So on August 15th, you did the $3,000. And then your debit to cash, credit to sales. Then they charge the fee at the end of the month, right? Now, probably this is not the only credit card sale, so in real life, you'd have a much larger fee. But maybe this is the only one this month for this company. So on August 31, when the processor collects the 4% fee, credit card expense is debited for $120 and cash is credited for $120. So it's the same $120. It's still not your cash. It's more like you're paying out the cash than just not receiving it. So under the net, it's kind of like you just never received the cash. And under the gross, you receive the cash, but then you pay it back out. All right, so that's where we're going to stop with these transactions. So I think it's not that big of a leap from what we've been doing for accounts receivable. All you have to do is remember, keep them separate for each separate person. But there's one control account that keeps the balances. And on credit cards, it's like cash, but you're either using net or gross. Net, that word net, as we've been using it all along, means subtract out. So for net method, you subtract out as you go. For gross method, you subtract out the credit card expense at the end. All right, so we'll stop right here. We're going to continue on with the next learning objective, apply direct write-off method. So that'll be the next video. Tune in for what happens when accounts go bad.